Mr. B. Prasanna joins us, Group Executive Head, and he runs Global Market and Proprietary Trading Group for ICICI Bank. Mr. Prasanna, good morning. Thank you for joining us. The sharpest decline in bond yields, they are sub 7% now. Looks like markets or the bond markets are telling RBI that more than 25, they need a 50 bips rate cut, and somewhere that is also getting priced in.
Good morning, Dipesh. Thanks for having me on your show. So, yes, there has been a good rally in the bond deals over the last week or 2 weeks, and it has been due to a confluence of a lot of positive factors, both on the global side as well as the domestic side. So, on the global side, you could see a global growth fears which was there is now slowly transforming into some kind of a recession fear. With the trade war, the kind of picking up in the trade war seriousness that the U.S. has now opened up on all fronts, including China, Mexico, as well as India recently. So there is a fear that there is going to be a fall-off in the global growth and hence inflation too continuing to be moderate. And so there have been estimates of recession which have now started to come from some very respected investment banks in the U.S. So from that, on the domestic side, you would see, I heard your commentator giving a very good summary. Yes, the oil prices coming down from 75 to 61. The confidence that Indian inflation is also likely to be centered around 4%, which is the RBI's estimate. And the most recent Friday GDP data, which is, I would call it as a 20-quarter low or a 5-year low as far as the quarterly data goes. So from a growth perspective, all pillars of growth are faltering. I mean, consumption, which is doing well for India for all these years, which has actually not been doing well over the last 2-3 quarters. Investments was doing well, but even that has now faltered in this particular quarter. And since the global growth fears are there, even exports are unlikely to do well with trade wars and whatnot. Even if you look at the high-frequency indicators in April, which is actually the quarter one of FY20, none of them are actually showing big positivity. These are like automobile sales, rail freight, petroleum consumption, so on and so forth. So all said, I think the market is now expecting for a 25 basis point rate cut in June. And maybe the expectations are for a bigger cut over the next 2-month period, maybe 25 to 50 basis points.
However, even for that matter, Mr. Prasanna, if it's 50, do you think that may not really be a necessary? I mean, low interest rates are a sufficient condition, but not a necessary condition for economy to turn around. We are talking about the March GDP data for Q4, and that GDP data for Q1 is going to be equally bad because election process was on, and nobody did any kind of spending, and the big ticket consumer purchases is also delayed. So what I'm trying to understand from you is that one side you got a painful reality of the economy. Second side, if even interest rates come down also, that monetary stimulus may not really heal the economy.
So you're right again, Nikunj. So I think there are a couple of other things which are probably required to be done, which the market is expecting the Reserve Bank to follow up on. First, of course, is the rate action. The second is the rate guidance. I mean, RBI has cut rates twice successively in the last 2 policies, but they have kept a stance at neutral, which basically indicates to the market that there is no forward-looking expectations of a cut at that point of time, which is also possibly hindering transmission to some extent. So there is an expectation that they will probably now go the whole hog and actually cut rates as well as change the guidance to an accommodative stance, which indicates that there could be more coming in the August policy. And the third thing is on the liquidity stance. So a lot of discussion has happened over the last 2-3 years as to whether what kind of rate, whether the liquidity stance needs to be aligned with the rate stance, because RBI has been going with a liquidity deficit stance for most of the time, and even when rates have been cut. And I think a liquidity deficit stance does lead to hindrance in transmission when the rates are being cut. So there is a possibility that RBI comes around and maybe at least puts out a discussion paper or maybe even decides to do away with the deficit liquidity and go into surplus liquidity. So if they do that, that could be really positive, which basically means that the animal spirits of the lending side of the banking system would actually come out, and they will actually looking out for assets to lend to.
Prasanna, more importantly on the question of liquidity, considering the kind of crunch that the system is facing and the liquidity transmission or the rate cut transmission not happening since the last 2 rate cuts, how do you think the RBI is going to address that in the next monetary policy meet?
That's what I was saying. I mean, they would look at some kind of a liquidity adjustment in the liquidity stance from deficit to maybe surplus liquidity. And having said that, even if they are not actually signaling, they have been actually coming out with quite aggressive open market operations and buy-sell swaps where they have been providing liquidity to the market. So now the market is actually a little comfortable from systemic liquidity in the sense that this is a period when liquidity actually comes back. The currency in circulation actually declines, comes back into the banking system post-election period, as well as the fact that the government spending is likely to pick up post-election, which will also lead to more liquidity in the system. So even if RBI were to stay away from giving liquidity, the system is likely to be positive for the next 2 months. And in addition to that, if they were to come out with a very explicit stance to say that their objective is to bring it to surplus, then to that extent, the signals are going to be much more stronger, and the rate cut, if they do it, would be transmitted across the bond markets and maybe across the lending side much more stronger than before.
All right, thanks very much then for joining in and giving us a take as to what you're making of the overall bond yield.